Hey, welcome back. Today we're going to be diving into an investment vehicle that a lot of people use, but a lot of people overcomplicate as well, and that's index funds or ETFs, depending on which way you want to play it. We're going to be going over 4 index funds today that you can buy and hold forever. They will guarantee to make you rich. Now, a couple caveats with that. I know some people are going to the comment section and go, well, it might take you 70 years at 9% interest and dollar cost average and blah, 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 bblah, blah. Okay, fine. You got me. That's one way to go. However, so many people put in the comment section of my videos, which stock, which yield, which bond, which I'm 30 now and I'm 50 then and I'm 70 and my risk factor goes down and my risk parity goes up and dollar cost averaging this and what's the yield and all these different things. But I thought it'd be interesting today just to go over 4 ETFs that you can hold forever. You don't have to do anything. You can buy them, you can dollar cost average, and these are by no means a comprehensive. There's several different ETFs or index funds you could buy from many different brokers. But the first thing we're going to do is I'm going to continue to ask and bring in more artificial intelligence into my videos. A lot of people have asked me about it. A lot of people have asked, what do I do? How do I make these decisions? What do I do? First things first is I'm going to go over to ChatGPT and ask ChatGPT exactly what I want. So ChatGPT, you are an expert financial advisor. I can't spell today, evidently. You are an expert financial advisor. You know everything about finance. I want you to create a portfolio of 4 index funds that I can buy and hold forever. Now, for those that haven't been watching the channel, I want you to comment down below before you see this. Don't cheat. What index funds do you think are going to show up? Do you think they're going to be all Vanguard? Do you think they're all going to be BlackRock? Do you think it's going to be State Street, Schwab, Fidelity? I'll let you know at the end, so make sure you stick around because we are going to be going over the 4 that I chose to build, and it might be a little bit of a surprise, but I want you to go down there in the comments real quick and comment what you think they are. And while you're down there, make sure you gently squeeze that subscribe button. It does help out the algorithm and it helps us create more content. Okay, so I'm gonna go ahead and hit enter and see what it does. I will preface to say I've done this several times a day, had to work out some of the bugs. I actually don't know what it's gonna come back with because as a large language model, which this is, it's constantly learning, it's constantly evolving, it's constantly updating and giving me the best feedback. So when I ask it this question in another 2 hours, I may get a different answer, and that's okay. All right, we see some of this is coming in, and we see that we did focus on, it looks like it is going to buy and hold forever. I asked it for 4 index funds that I can buy and hold forever, and it's looking and doing probably some modern portfolio theory where we're doing a mix of broad-based assets across bonds, across international, across domestic, and across dividend yield. Looks like it's picked 4, VTI, VXUS, BND, and VNQ. So we've got all 4 of these are Vanguard. It looks like ChatGPT is a Vanguard fan. I think you could probably go in and program it and say, hey, avoid Vanguard. Actually, let's go through and do that. I'll do that next. But first things first, the first one is VTI, and that's just a U.S. equity index, large, mid, small cap stocks, very low interest or very low expense ratio with a small yield. International equities, the VXUS, this one's across Asia Pac, Europe, and it does give you that international exposure that you're not going to get from VTI. I thought this was interesting though. BND from Vanguard, another bond fund. So, less risk, less reward, but when times are tough, and times are going to be getting very tough, don't kid yourself, this will definitely come into play. And the last one, real estate, VNQ. I did not expect it to do that. I really didn't. REITs, though, do have often a higher dividend yield, but in a market like today where interest rates are rising, you could do some collateralized debt obligations and potentially make money, or you could shore up some liquidity from a company by purchasing debt from them and helping offload some of their real estate. There's tons of opportunities for debt financing. So I am a little surprised that they picked this one. It looks like it's going to go with the 50-30, 15-5. So the VNQ from a real estate perspective is the smallest, then BND the bond, and then the 2 big powerhouses make up 80% would be VTI and VXUS. So those are big. I understand why they did that. And it also goes through and says, hey, this is a generalized portfolio structure, age, risk tolerance goals. I've talked about this repeatedly. But what happens if I go through and say, hey, that's great, ChatGPT, but I want you to exclude Vanguard entirely and now create a new portfolio. Thanks. Now, before it comes back real quick, go down and tell me what you think it's going to do. Do you think it's going to be, what do you think it's going to be? BlackRock, State Street, Schwab, Fidelity, what's it going to do? All right, looks like the first one is iShares, so that's BlackRock. iShares, that's BlackRock. iShares, that's BlackRock. And I'm guessing that number 4 is going to be real estate. Well, Schwab. Okay, so we have 3 BlackRock, and then we have a Schwab real estate fund. Much like what we saw before with Vanguard, we've got a big exposure. So we've got ITOT, which is the investment results of the total market. We've got international with IXUS. We've got AGG with bonds, and then we've got Schwab with real estate again. So the same breakdown, we've got 80% in basically stocks and bonds, stocks, and we've got 15 in bond and 5% real estate. So we did 50, 30, 15, 5 there. It's all the same thing. Now, no surprise, if those of you that chose that thought Vanguard, you're absolutely right. That's what I chose. The 4 that I have are, starting with number 1 is VTI. And obviously, if you've watched the channel, you know that I'm a fan of this ETF. You know, because of the low expense ratio here at 0.03, it's what not to love. They've been around a long time. It's over a 20-year track record. Minimum to invest is $1. Market prices continually went up, and you'll see the VTI over the 10-year 11.23%. And the expense ratio is much, much lower than the market average of other similar funds. However, it doesn't mean that it's bulletproof, and it doesn't mean that it's right for everyone. But if you're looking for 4, and I can even get it down to 3 if I want to, funds to buy and hold forever, I would say VTI has to be in there. Again, comment down below. Let me know what you think. Is VTI one for you or not? And if you're not a Vanguard fan, that's okay. I have plenty of money that's in other places besides Vanguard. Next one, VOO, Vanguard, S&P 500 ETF. Why is this different? What does this look like? So VTI does everything in the stock market, small, medium, and large cap. Vanguard S&P 500 is just what it says. It's only the companies in the S&P 500. Same expense ratio at 0.03. Hasn't been around as long as VTI, but still a pretty healthy track record. And year-to-date returns 13%, so a little bit higher than VTI, I believe. Let's check and see actually what we've got here. 12.18. So VOO, if you own VOO this year, you've done a little bit better. The premium discounts very good, and a very high trading volume, which is good because you want to see that from institutional investors. That could be academic institutions like endowments, that could be government like pension, or that could be retirement funds like 401k. You want to see a lot of heavy volume. You want to make sure that it's being traded a lot. PE ratio 22 or 22.9, which is the exact same for the benchmark, which isn't surprising. Price to book is almost what you'd see on a benchmark fund as well. Number 3 is VEU. This is the all world ETF. So we were doing everything in the stock market, then we were doing the 500, and now we're going to be doing the entire world. This looks at stocks from, and if you look here, it track performance of all the FTSE or the FTSE All World US Index. So you can get broad exposure across developed and emerging non-US equity markets around the world, passively managed index with just indexing. Now this one's expense ratio is a little higher, but you're also getting an exposure outside the United States, and you will pay for that type of diversification. Asset class is a global stock. It's been around 2007, so not as long as VTI, but longer than VOO. So if you're looking for more track record focused, you'd probably want to go with this over a VOO. They do have there's a ton of volume, almost 7 million shares traded in a day. And if I go down here from a P&E ratio, which I like to see very low, so I'm only paying 12 times earnings for every dollar of profit, and then the price to book is even smaller. So I really like the P&E on this. I really like the price to book, and the return on equity is 12.3%. I really like that. Okay, and the last one is BND. So I kept it all 4 Vanguard like this. I showed you in ChatGPT how you can do it a little bit differently. So again, if you're not a Vanguard fan, I understand. I'm not going to get upset. I'm not going to take offense to that. I could build portfolios anyway. Again, I'm trying to make this as simple as possible so that you understand that you don't have to buy individual stocks. You don't have to guess. You can if you want. For 90% of people, this way makes a lot more sense. You're able to diversify, low expense ratios, dollar cost average, and call it a day. All right, as you saw in the last, when we looked at ChatGPT, it did show me that it had a little bit of bond exposure. I traded out the real estate exposure for the international exposure. And then I also kept bonds, and mine would be much the same, 50, 30, 10, 10. So the bond here is 0.03 expense ratio. It's been around as long as VEU has, since 2007. If you look down here, you'll see 25-day moving average is 6.4 million shares and almost 6 million on the 50-day. The average duration kept is 6.2 years, and the effective maturity is 8.5 years. And you'll see most of this is government, and of the government, you'll see most of it's AA, AAA, and A. For those of you who don't know, AAA is the best, then AA, then A, then triple B, double B, B, then triple C, double C, C, etc. The higher the score, as in AAA, the lower the return, because you're paying for that. There's not as much risk, so there's not as much reward. But if you get bonds that are double B, B, triple C, double C, even a C bond, the exposure goes way up, which means the profit goes way up, but the risk goes way up as well. Fixed income, here's some of the holding details. So these are some of the bonds that they've sold into: Amgen, Amazon, and all that means is those companies took out loans and they're being paid back, so you're getting a percentage of that back in distributions. And the distributions here, it looks like the dividend is paid out every month. So ex-dividend date 10/2. So as of today, the state's being recorded on October 2nd. They're paying a dividend today, and it looks like they're doing it every month. You want to also look and make sure that the dividend share price is going up. So 12.23, so almost 10 months ago, you're looking at 17 cents a share, and now it's 19. So you are seeing the dividend the price per share from a dividend perspective continue to climb, which is another thing you want to make sure you're aware of. Okay, the last thing I want to go over is the 4 index funds from the Motley Fool that they chose here. If you're looking for just, hey, you don't trust this guy, who is this guy, you don't have to listen to me, look at someplace like the Motley Fool and what they chose. Interestingly enough, I believe they chose, they did the Vanguard Total Index, which I did, VTI there. They did the Vanguard Total World, which is VT. They did Invesco QQQ. I've talked about that before on the channel, which tracks the NASDAQ 100 index, the 100 largest non-financial companies on the NASDAQ. So Apple, Microsoft, Amazon, Tesla, all these, you can read these here. Starbucks, Intuitive Surgical. So if you wanted to do a 3-part portfolio, you could do QQQ, you could do VT, you could do VTI. I don't see any problem with that. You're not getting the bond exposure, you're not getting the real estate exposure, but you are diversified. You've got low expense ratios, and you've got a proven track record of income. So with that being said, comment down below. What do you think? What do you think of my portfolio? How would you tweak it? Do you like it? You want to throw it out? You want to get rid of this? You want to get rid of that? You want to add this? Let me know. Comment down below. Don't forget to subscribe. And as always, don't forget to design your financial freedom. Take care. Bye-bye.